The next is a very new concept, which is called the one-person company, the one-man company. It's called OPC, which has been brought into the Companies Act of 2013. The government feels the importance of promoting such enterprises without having the complexities of a private limited company or a public limited company. The ease of doing business on the OPC is far less strenuous and far less cumbersome. The next one is the private limited company. So if you see, each of these format is evolving from a less complex to a more complex environment. You have the sole proprietorship, then you have the two people coming in partnership, then you have 2 plus unlimited, which is somewhere between a private limited company and a partnership, that is called the LLP. In between, there is a one-person company, which is it is a company, it is a limited company, it's a private limited company, but only one person can be the director. Then we go into the private limited company. And there is a close connection between a sole proprietorship and a OPC. The reason is because in an OPC, the liability of the director is limited to that entity in case of a claim, whereas in a sole proprietorship, his business, his assets, his personal assets all come under the liability bracket should their need arises for settlement of liabilities. So coming back to private limited company, that is the first model or format in which the business takes on a corporate structure. Typically in a private limited company, you can have a minimum of 2 directors or 2 members or shareholders, and you can have a maximum of 15 directors, whereas in case of members, shareholders, you can go up to 200. Now, this is a traditional form of business which many entrepreneurs have grown either from sole proprietorship or towards partnership, or from that onwards to the private limited company format. The final one is basically when the private limited company has attained certain minimum scale and standards of operation, and it needs more resources in terms of capital, borrowing. That's when it goes listed. That is where it becomes a public limited company, where it is then governed by the listing authority, which is a SEBI in India. And in a public limited company, you can have seven would be the minimum number of members, and you can have unlimited number of members on the top side, because you're coming into the market with shares, so you can have as many shareholders as you want to be involved in the capital participation. As far as directors are concerned, you have 3 minimum directors and 15 maximum directors. This is the brief overview of the type of business entities. The next slide is on, well, once you have the business format set up, you'd like to know what is this basic accounting principles, what are the concepts, what are the conventions in typical bookkeeping environment or accounting environment. To put it in a very nutshell, as I said, the very brief overview, when you're going into accounting principles, let's look at the assumptions. One is, it is a business entity. A business entity is different from its owners. There's an element of money measurement, that means each transaction can be allotted a value in terms of rupee or dollars, whichever currency you're accounting for, and it can be measured. The accounting, the recording of accounting entries are basically for a given accounting period, usually 12 months. Sometimes it goes into 15 or 18 months, depending on the situation as far as income tax and pre-incorporation, post-incorporation, first-time creation of financial statements are concerned. Then there's a going concern assumption. That means every accounting transaction or bookkeeping is based on the principle that the assumption that the business is going to go on indefinitely without any limited tenure or project. So all entries in the books of accounts are based on a going concern assumption. because the other, if you want to know what is other than going concern, it could be a limited project, where in that case the treatment of accounting transactions and assets and liabilities will vary. Going into concepts, there is something called the dual aspect. In the dual aspect, we have the debit and credit side of every transaction that is recorded in the books of accounts. There is some money coming in, there's an expense, there is a treatment of debiting and crediting account. It could be a liability, it could be an income. Most of you are from commerce background, so you know what is the concept of double entry. This dual aspect basically refers to that. Then there's a revenue realization, which means basically you record the entries in your books based on the actual revenue realized. And there is, of course, this linked to your money concept, money measurement. Then there is a historical concept. That means every asset in your balance sheet has an historical, it has a historical cost, and it's recorded on that value. Also, accounting transactions are usually 99% are based on transactions that have already incurred, and you're capturing it on your books of accounts. Then there is a matching concept. Matching concept is basically your expenses and income has to be commensurate and sort of consistent. You cannot have income recorded for 15 months and expense recorded for 12 months, and then you try and work out your profit and loss. Then there is a cost concept. In the cost concept, in the balance sheet of all businesses, the assets are recorded at cost and not on the market value or on what is the future value of the potential earning capacity of the asset. Then there is the objective evidence. There is no bias. When you're talking about objective evidence concept, there is no, the recording of transactions based on objective facts and figures, not on individual biases. Recording of transactions are based on objective assumptions. Then we go to conventions. Typically, conventions are full disclosure, materiality. Here we are talking materiality. When you give a financial statement, you're normally supposed to say true and fair. So in that, when you see errors and deviations, then we make sure that this materiality concept is not violated. It doesn't vitiate the true and fair view of the financial records. Then there is something called the consistency. Consistency means you cannot have every year a different assumption on your underlying transactions. For example, depreciation. Depreciation there are many ways of calculating depreciation. Once you select a certain basis or way of recording it, you cannot change it without giving adequate disclosures in your balance sheet. You cannot do anything arbitrarily, because then what happens is the reader of the financial statements loses track. In one year you do valuation of inventory in a certain way, another year you do a different way. Therefore, to remove that, the usual convention is to record these transactions in a consistent manner so that the user of financial statements are comfortable and have matching and are comparable from year to year. If you recollect, all financial records are having previous year, current year figures disclosed. So unless you have a consistent way of recording them, you could be misstating your financial data, which could create confusion. And if you have to make a change, then you have to have specific disclosures in your financial statements. The final one on the convention is the conservatism. You don't record an income unless there is all uncertainties removed from the event happening of the transaction. Say it could be a sale, it could be a service rendered. On the other hand, expenses, you have to record minute there is a liability that has arisen. So that is called conservatism. We go to the next slide, which is basically reporting of financial statements. Every country has their own reporting framework. However, these are based on IFRS issued by IS from time to time. Now, what is IFRS? IFRS is International Financial Reporting Standards. And these are issued by the International Accounting Standards body at the from the head office. And this need for IFRS reporting standards has arisen because in the past, people used to record their transactions in the books. in a fairly arbitrary way, which is to mislead the users of financial statement. And that is why a lot of frauds happen. People used to keep recording assets and transactions off the balance sheet, not bring it onto the balance sheet, and therefore you have very renowned failure cases like Lehman Brothers and Enron. All this has led to the Securities and Exchange Board of US clamping down and bringing in international and uniform ways of recording a transaction, computing a certain asset or value or liability, and minimum disclosure that needs to be given under each financial reporting standard. There are many financial reporting standards. In India, we use the IND AS, that is called the Indian Accounting Standards, which is issued by the Minister of Corporate Affairs from time to time. If you go to the MCA site, you'll find all the recent accounting standards issued by the government, which all auditors of listed and limited companies have to follow. And if the company does not maintain it, the audit report gets qualified. And a qualified report is not acceptable for professionally run and good companies. And when I say India follows IND AS, Indian Accounting Standards, it is by and large convergent or very close to the international financial reporting standards. Now remember, as I said right at the beginning, IFRS again is one area which is by itself an area of specialization, and each of these standards are complex and it needs an expert kind of understanding. We then move on to financial statements presentation. This format is as defined by the Companies Act, Schedule 3. Every company who is coming under the Companies Act 2013 purview will have to have these minimum information on their financial reports. We have the components of balance sheet, share capital, reserve, surplus, unsecured borrowing. If you go to the Schedule 3 to Companies Act 2013, you will find explanation to what typically comes under each of these subheadings. We quickly move on to what are the ways and means of financing a business. We have the main heading, which is the share or ordinary share capital, typically called the equity share capital. And these people are the real risk bearers of the business. The next is the preference share capital. These people do not bear as much risk as the equity share capital subscribers, and they have preferential rights insofar as enjoyment of dividend and also at the time of liquidation. And this is again a very basic point which I'm just trying to elaborate on the balance sheet presentation you saw just before this. Now, what are on the balance sheet? You find something called the revenue reserves and capital reserves. So the revenue reserves are typically which are from coming out of your profit and loss account. Since you're all from commerce background, I assume you understand what is the transfer of reserves to balance sheet, and and it's only after from here usually the dividends are declared and distributed. Whereas you have the capital reserve, which is not freely available for distribution because there are some statutory rules and regulation which needs to be followed before they come up for disbursement as profits. The next concept is which a business person running a business or a person understanding a financial reporting or accounting finance would need to understand is net worth and enterprise value. Net worth is typically the assets minus the long-term liabilities and the current liabilities, which is basically nothing but the share capital and reserves and surplus, less than intangible assets. And typically that is usually called the book value. Now, the enterprise value is something which is much beyond the book value. It is arrived at using different valuation methods, specifically for unlisted companies, and it has a lot of bearing on the projections and earnings of the business. Then we move on to secured borrowing, which is basically typically the bank borrowing. Then you have the fixed charge. When the organization borrows, then it can have its security with respect to a particular asset. Whereas there's a floating charge when there's a group of assets, and that comes as a security to the bank or the lender. Then there is something called the collateral securities, which is basically a group of securities, which is assets or leverages as a group, which is earmarked for security for the lender.
Outside the business.
Yeah, it is basically typically outside the assets of the company. The next one is unsecured borrowing. Typically, this and non-current liabilities. Unsecured borrowing would typically be where there is no sort of security offered to the lender. And the company is taking this liability on. Usually, these are insiders like the directors who themselves give loan to the entity. And non-current liabilities are basically long-term in nature, not current. Current and non-current, I'm sure you people understand. It is with respect to the operating cycle, 12 months or whatever the operating cycle is. Anything beyond that becomes non-current. It could be long-term loans which go beyond one balance sheet to another balance sheet, the liability which you carry year over year. We come to current liabilities. Again, as I said before, this is determined by the periodicity and operating cycle of the business. Operating cycle means from the point you create a product till the point you sell in the market and get your money back into the system.
Cash to cash.
Cash to cash, yeah. So the current liabilities, when you say current, it basically means within your operating cycle, what is your liabilities which you need to meet? Typically 12 months. Anything that you're going to pay in the next 12 months is coming into this category. Now, in the balance sheet, a very close and relevant concept is the ratios. This is a combination of various. Components of the balance sheet. When you see we identified two kind of ratios, which is very relevant in today's environment, especially with all the COVID complications going on and companies coming under need for restructuring. There is a recommendation by Mr. K.V. Kamath and his team, which talks about solvency ratios and liquidity ratios. Typically, solvency ratios are debt equity ratio, TOL, total outside liability upon total net worth. Then there is a liquidity ratios, which is typically the current assets upon current liabilities, the asset test ratio, the debt service coverage ratio, DSCR. These are typically ratios, and industry to industry, the threshold values and ratios are fixed because each industry has its own business cycles and own business capital requirement and liquidity specialities in which it's generated and spent. Then we go on to the non-current assets, which is typically, now these headings are typically from the Schedule 3 format. In the past, it used to be just fixed assets. Now it's called non-current assets, and it's coming and tangible fixed assets. And there's a non-current also has intangibles, which is basically your trademark, your intellectual property rights, which are not tangible, but they all come under the non-current assets. And then there is the current assets. This is basically the other side of the current liabilities or the mirror of the current liability. We have inventories, which you're going to sit, which is basically what you're going to sell in the next operating cycle period, 12 months. There's a receivable which you're going to collect from the market. The advances which you paid, which you're going to get finally settled by the next operating cycle. And then finally the cash and cash equivalent, which is nothing but the cash and bank balances as is traditionally called. In your financing of business, you have the own capital, your term loans and working capital loans. Own capital means what we touched upon already, equity and preference capital. Term loans are basically loans which are non-current loans, which are for a period of 3 years or more, as per the loan agreement extended by the lender. Then there's a working capital loan, which is basically for your day-to-day running of the business and is limited to usually overdrafts, cash credits, and also your trade finance lines extended, like your LC limits and your bank guarantee limits. All these comes under working capital financing. We then move on to what briefly touch upon what are the advantages of capital gearing. What is capital gearing? It's basically how much of your capital is own capital versus borrowed capital. Why do people borrow capital? Typically to take benefit of the tax benefits on interest. That's what called the tax shield. If you can earn by return on investment, return on equity improves with good leveraging. At the same time, we make sure that the profitability of the company is maintained, and if you use your borrowed capital efficiently. It is a decision which varies from industry to industry, from business to business. How much is borrowed, how much is own capital. Move on to now the direct taxation typical concepts. One of the most important concepts is previous year and assessment year. Assessment year, if we are talking about assessment year, let's say 2021, then the previous year is 1920. Then we have residency status. Residency status is very key to Income Tax Act because it is this that determines whether you are taxable or not taxable. If you are a resident, you are taxable. In the recent this residency status or this provisional income tax talks about how many days you are in India, resident in India. It used to be 182 days or more, but recent taxation amendments have brought in a new dimension to it. If you are an Indian citizen or a person of Indian origin and you're coming to visit India, and if you stayed in India for 120 days or more with an income of 15 lakhs or more, then you are deemed to be a resident of India, and therefore you are liable for your incomes all the incomes arising in India. This is again a new enactment which has been brought in to cover situations where people manage their tax residency in such a way that there is no liability either in India or in other countries. Exception to being by way of a CBDT circular is that if you are a person bona fide employee outside India, then this 120 days thing does not apply. Then of course there is the finance and the budget presented within the finance bill, which every February, March they declare what are the rates and taxes, what are the new rules, what are the amendments, what are the slab rates, which people look forward to as business people to understand the tax implication. Remember, tax is always on accrual basis, not on cash basis. So your tax liability comes on basis of minute your income is accruing to you, not based on actual receipts. And finally, another important concept is tax deducted at source. Sometimes income tax departments do not have access to the tax recovery from the recipients. Therefore, the person making the payment is then made responsible. Therefore, the person making the payment is bound to meet the tax deduction at source provisions.
Salary.
Yeah, typically you'll find salaries, rents, people making the payment. That means the company, you're an employee, and the employer, therefore, while making the salary payment to you, will deduct the tax at source. Section 194 broadly talks about the various kinds of TDSs. Finally, we come to the basic heads of taxation. We have salaries, house property, business and profession, capital gains, other sources. The most complicated of this being business and profession. There are enough and more sections and subsections which talks of what is allowable, what is not allowable, what are expenses which should be allowed and what is not allowed. And there are enough and more case laws under each of these sections where there are disputes raised by the assessee, and the department and assessee finally have gone to various legal forums to resolve it. But the biggest of all these 5 heads, most of the complex things are lying in this business and profession. Salary is a fairly straightforward. You know what is allowed, what is taxable, what is valued as a perquisite. House property, again, relatively simple. Capital gains, it deals with all the situations arise which by way of transfer of assets by an assessee and there are minimum holding period to differentiate between long-term and short-term capital gains, which the short-term capital gains have a higher rate of taxation versus the long-term capital gains. They are all out of the four heads we just discussed. Anything else falls under the other sources. If anything, any income which does not come into one, the first, second, third, and fourth will go into the fifth one. Typically, what comes over here is bank interest, dividend income. These are examples of what is called other sources, which is taxed. Finally, we come to the concept of in the income tax, which is pretty important for people doing business. That is transfer pricing. This is a huge area there was a statistics that came out of all the cases in pending with the income tax department. Transfer pricing accounts for 50% of all the legal disputes. Now, what is transfer pricing? Companies usually, particularly associated companies, when I talk about associated companies, subsidiaries or holding companies of subsidiaries, of subsidiaries, they in different countries, in different tax regimes, they manage their purchase price and selling price, to give an example, in such a way, they used to do it in such a way that the tax liability within India is minimized. And that came to notice of tax authorities, and that is how this concept of transfer pricing has come into being, where this set of rules under the Income Tax Act, they restrict or lay down principles which is allowed for arriving at your profits, your trading profits. And there are many other transactions which comes into transfer pricing, but to make it simple, we talk about buying and selling. And there are the underlying principle is you must always maintain an arm's length pricing methodology, so that while arriving at the price, or purchase price or selling price, there is enough evidence and records within your organization to convince the tax authorities, the transfer pricing officer, that you have followed arm's length pricing methods. This is again a huge domain and chapter by itself, and there are people who have spent their life in specializing in this area of taxation. Come to the end of the brief seminar on this, and I think I left out something on, if I just go back on what is the valuation methods. I just want to touch upon that point again. Typically, there are three broad principles of valuation. We have the cost approach, then there's a market approach, and there's a discounted cash flow. Now let me start with discounted cash flow. In this method of valuing an organization or business, a lot of weightage is given to the forecast of the free cash flows over the next 4 years, 5 years, using the latest period's cash flow as a starting point. This is then discounted to arrive at the present value of the business. Again, this is a huge area by itself, but I just touched upon it. Then there is something called the market value approach. In the market value approach, you have something which is called the relative value. That means you compare your organization's key parameters like price upon earnings or EBITDA to arrive at what would be the value of the business. Now again, the SEBI has now required registered valuers who are certified registered valuers who can only undertake the valuation activity. The first method is the cost approach is basically the book value approach. I think we've come to the end of the quick short overview of accounting, business, and direct taxation.